Let me ask you something. How long would it take you to save a £30,000 deposit? 2 years? 5 years? Maybe longer? Now let me tell you something that might completely change how you think about property investing. The wealthiest property investors in Britain almost never use their own money. Not because they don't have it, because they've discovered something far more powerful. They've learned that whilst you're busy saving, opportunities are passing you by. And there's a smarter way to build a portfolio without ever touching your savings account. In the next 15 minutes, I'm going to show you exactly how they do it and how you can start using the same strategy this month. Here's what most aspiring property investors do. They scrimp, they save, they put away a few £100 every month, watching their deposit fund grow painfully slowly. Maybe you're doing this right now, working overtime, cutting back on holidays, telling yourself that one day you'll have enough. And look, I respect that discipline, I really do. But here's the uncomfortable truth nobody talks about. Let's say you're saving £500 a month. That's a solid effort. In 5 years, you'll have £30,000. But in those same 5 years, UK property prices have historically risen by 15 to 25%. That £200,000 property you wanted, it's now £240,000. Your deposit requirement just increased by £8,000. You're running on a treadmill that's getting faster. Here's a statistic that changed everything for me. 91% of UK property millionaires used other people's money to build their portfolios. They didn't wait until they had enough cash. They found partners, structured deals properly, and scaled whilst everyone else was still saving. The question isn't whether you can afford to use OPM. The question is whether you can afford not to. So, what exactly is OPM and why does it work so well? OPM stands for other people's money, but it's not what you might think. This isn't about borrowing from friends and hoping for the best. It's about creating genuine partnerships where everyone wins. Think of it like this. There are people out there right now with cash sitting in savings accounts earning practically nothing. We're talking ISAs paying 4%, premium bonds paying maybe 4.4%. After inflation, they're actually losing money. These people want better returns. They want their money working harder, but they don't have the time, the knowledge, or the inclination to find property deals themselves. That's where you come in. Your job isn't to have money. Your job is to find opportunities that others can't find and structure them properly. Let me give you a real example. Last year, I analyzed a 3-bedroom terraced house in Manchester. Purchase price, £165,000. After refurbishment costs of £15,000, the property valued at £210,000. Monthly rent, £950. Gross yield of nearly 7%. Now, the investor I partnered with put in £80,000 to cover the deposit and refurbishment. In return, they received a 10% preferred return plus 50% of the equity. Their return? Significantly better than any savings account. My return? 50% of a property I didn't have to fund. This isn't about begging for money or being desperate. It's about solving a problem for someone else. You're turning their lazy cash into genuine wealth-building assets. Right, so the obvious question, where do you actually find these investors? I break this down into 3 levels, and I recommend you work through them in order. Level 1 is your inner circle. Family, friends, colleagues. Now I know what you're thinking. Mixing money and relationships is risky. And you're right, it can be. But only if you do it wrong. The key is professionalism. You're not asking for a favor. You're presenting an investment opportunity. You come prepared with numbers, projections, and a clear structure. If they're not interested, fine. No pressure. Move on. Level 2 is your professional network. Accountants, mortgage brokers, solicitors. These people talk to high net worth individuals every single day. And those clients are constantly asking, Where should I put my money? Build relationships with these professionals. Explain what you do. Ask if they'd be willing to make introductions when suitable opportunities arise. Level 3 is public platforms. LinkedIn, property investment Facebook groups, local property networking events, REIAs. Here's the line I use at networking events. Ready? I source high-yield UK property deals that consistently outperform savings accounts. I'm looking for capital partners who want better returns on their cash. Would that interest you? Simple, professional, direct. You're not selling, you're qualifying. If they're interested, brilliant. If not, you've lost nothing. Finding investors is only half the equation. You need to structure deals that protect both parties and to make the opportunity genuinely attractive. Here's the structure I recommend for beginners. A 50-50 equity split with an 8% preferred return. What does that mean in practice? The investor puts in the capital, let's say £50,000. Before any profits are split, they receive 8% annually on their investment. That's £4,000 per year, guaranteed before you see a penny. After that preferred return, any additional profits from rental income or eventual sale are split 50-50. Why does this work? Because the investor has downside protection through that preferred return plus meaningful upside through the equity split, and you get 50% of an asset without putting in capital. Now here's the crucial bit. You must structure this properly from a legal standpoint. I recommend using a special purpose vehicle, typically an LLP or limited company, specifically for each joint venture. You'll need a proper partnership agreement or shareholders agreement drafted by a solicitor. This isn't optional. This protects both of you and ensures HMRC treats the arrangement correctly. To help you get started, I've created a free partnership deal structure checklist that walks you through everything you need. The link's in the description below. Let's talk about what happens when you actually sit down with a potential investor. First, you need a deal package. This is a professional PDF that presents the opportunity clearly. It should include the property details, the numbers, the investment structure, the risks, and your credentials. When you present it, here's the approach I recommend. Don't be salesy. Don't be desperate. Be consultative. Walk them through the deal calmly. Explain the numbers. Answer their questions honestly. If something's a risk, acknowledge it. Here's an example of what to say when you're ready to ask for the investment. This is a buy-to-let in Sheffield producing £950 per month. I'm looking for one capital partner to fund the £50,000 deposit in exchange for an 8% preferred return plus 50% equity. I'll handle everything: sourcing, renovation management, tenant placement, ongoing management. Does this sound like the kind of passive investment you're looking for? Notice what I'm doing there. I'm presenting facts. I'm being specific. I'm explaining what's in it for them, and I'm asking a qualifying question, not begging for money. If they say yes, brilliant. Move to the next steps. If they say no, thank them for their time and ask if they know anyone else who might be interested. Every no gets you closer to a yes. Here's the truth. Money isn't your limitation. It never was. Your network is your net worth. You find the deals. Investors fund your dreams. Everyone wins. Download the free OPM Partnership Structure Checklist using the link below. It'll walk you through everything we've covered today and give you a template to start your first conversation. If this was helpful, subscribe for weekly strategies on building wealth through UK property. I'll see you in the next one.